We continue this week with our summary of Becoming Your Own Banker by Nelson Nash. Last week was episode 3. This is an 8-part series, and episode 3 started the coverage of the human element portion of this book. We're into episode 4, continuing the conquering of the human element. This is going to cover chapters 11 and 12, and it discusses a little bit of mechanisms. As a reminder, we're covering this book just in summaries while also providing some of our perspective. We definitely recommend pick up the book. Nelson Nash is the godfather of infinite banking and started off this whole thing and has been opening minds and transforming the financial space for decades. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWell Finance.
And Conquering the Human Element, this is about discipline and design. Chapter 11, Use It or Lose It.
Nelson, in this chapter, discusses this idea of borrowing against your policy at market rates and charging yourself those market rates because you don't want to lose and diminish the value that you have in your policy. And he was also operating in a much higher interest rate environment, a little bit of different times. The policies were pretty strong with their dividend payouts. So a lot of different things that are interesting about the time, and things are a little bit different, but largely some concepts are still the same.
And Nelson talks about everything in his book through stories. In this one, he brings it up in reference to the economic value added and how IBC has to become a way of life. The reason he advocates for charging market interest rates is because if you weren't being your own bank, you're going to be paying those rates to somebody else. And everybody has 2 jobs, whatever you normally do for work, and then being a banker. And if you have an actual business that's a bank, you want that bank to be able to stand on its own. And what makes it do that is charging interest rates that allows it to sustain itself. Now, a lot of times he advocates for charging more than what you might have to pay the insurance company when you're borrowing against your policy to do infinite banking. And there can be an argument for that in certain circumstances, but just know that it's not necessary in order to actually practice infinite banking and have success in these policies. It's just a way to add additional premiums if you otherwise aren't maxing out whatever the design was that you started with.
And that's really one thing. If you look at the illustrations and how he shows these concepts through the numbers in the book, which we highly recommend, again, picking up the book and reading it, he really shows that paying extra on top of what you might be required and in order to fit more cash in. But a lot of how we approach whole life at this point is optimizing such that you're max funding it, or at least we try to max fund it every year, such that you don't have room to actually put in extra cash. That is one thing to keep in mind, is we've really dialed in how we design these products that is a little bit different from what you might have seen in the time that Nelson Nash was operating.
Yeah, so if you're utilizing this book as a tool to help you understand the concept, if you buy a policy that you're already max funding in order to optimize the efficiency of it, and you want to do what Nelson says and pay yourself back market interest rates, which could be higher than the interest rate the insurance company is charging you, the net effect is you're just going to pay that loan back faster. And that can be just fine as well. So these things can still work together. We're just trying to mention this in a way that operates how we're actually seeing it be used today in relation to what he's advocating for in this book. Now, the main thing that he wants to talk about in chapter 11 is recognizing where the money is flowing so that you can ultimately recapture all of the interest on money that you're spending. Stop leaking it out to other entities. This is the key to becoming your own bank. Chapter 12 delves into creating the entity, and this has to do with policy design.
And he goes into this continuum, you could say, where things may have been single premium And then on the other side of that spectrum, you have term insurance. In the middle there somewhere is whole life insurance, where you're funding it over the life of your policy with that fixed costs in the whole life policy. And that's really what the foundational element of the infinite banking concept, as Nelson Nash proposed, is. And that is creating that entity in that whole life policy.
And he does recognize that the policy design should put your funding closer to that maximum limit, what we call the modified endowment contract limit. That is the best and most efficient use of any of these policies, and it will create the most cash value long term.
And that's, as I mentioned earlier, we really want to, in my mind, push beyond. If you look at the charts that Nelson Nash had, they weren't as close as we like to fund. And sometimes there's another thing where we'll have that space in there. But ideally, when we go into designing a whole life policy, we go in with this idea that we are going to try to get right up to that MEC limit and not cross it. He calls that out too. You don't want to cross that limit. There are protections. Companies will maybe give you a back out on turning it into a MEC sometimes, but you just want to be careful no matter what. Be aware of what your MEC limit is and what you're funding at so that you know you're not going to cross it.
Now, this chapter also is the first place I think that he really advocates for a whole life insurance policy as the vehicle of choice to do infinite banking. There are other vehicles that can be used for this, and Nelson just isn't a fan of things like index universal life. There are concerns around policies like that you don't get, especially in a traditional design, which was where he was coming from to start this out. There are a lot of things to be concerned about if you buy a bad design policy in some of the other flavors of life insurance besides whole life that you don't get if you buy whole life. Like the worst case scenario, the worst designed whole life policy still has a lot of guarantees that it will still provide and do that can work for infinite banking that you won't get if you get a bad design in one of the other types of life insurance. But that doesn't necessarily mean that you can't do infinite banking with index universal life insurance.
And really, we've talked about this in a number of episodes. We like IUL, and there's potential to do this with other things. We happen to think that both whole life and IUL have a place, and they both really work for this concept. But it is possible if you have a large brokerage account with secure assets in it, you could potentially use something like that. I think James has mentioned the idea of dollars in a mattress. You can have really whatever it might be. One thing that is advantageous about something like whole life or IUL is you do have that compounding effect that is there when you aren't deploying the funds, or even when you are deploying the funds in other cash flowing assets.
And he finishes up this with 2 hard and fast rules. Number 1, don't be afraid to capitalize the system. You've got to fund it if you want it to work later on. Realistically, if you look ahead 20 years and think about where you would be if you have a system built up and you no longer have to rely on somebody else to get access to cash, it just puts you in a totally different financial environment than you would otherwise be. So rule number 1, don't be afraid to capitalize the system. And rule number 2,
don't make policy loans without making provisions for paying them back.
And that means being a good banker.
Yes, and it is very important that at some point when you're using this, especially in that capitalization period, that you are paying back those loans. In the future, once you are beyond that accumulation phase, there will be a time where you may not plan to pay some of these back, and that's also okay. But that's not really what he's talking about here.
Yeah, there's a lot of flexibility when it comes to repaying your policy loans. You don't actually have to do it, but you want to make a plan to do it. You want to be a good banker because you want your banking business to be successful. That is one way to ensure that even if you encounter some rocky financial turbulence in the rest of your life, at least your banking business is still going to be profitable and be there when you need it. People do get in trouble if they start to take policy loans without a way to pay them back, and they start thinking about this as like free money. It's not. I recommend making payments on your policy, paying that loan, at least the loan interest each year, because it's painful. It reminds us that it's not free money. I think that wraps up Chapter 12 in this Discipline and Design episode. Do you have a call to action for our listeners this week?
It's time for this week's call to action.
I want you to picture if you ran into some amount of money. You could pick the hard numbers, but let's say if you ran into a $5,000 emergency and a $10,000 emergency or a $30,000 emergency. That can happen. HVAC unit blowing up and you have to replace a roof at the same time because of it. Whatever it might be, these are numbers that can happen. What would you tap to cover those expenses? Think about that. And if you just don't know the answer to that, you should have a conversation with one of us, learn more about this concept, because that is what this strategy can really help you with.
Yeah. So what you bring up is generally what people will utilize emergency funds for. And if that was your answer, well, I have an emergency fund for that. Where are you storing those dollars? Most people have their emergency fund in either a checking or savings account, and it's really not doing much for you. I would recommend considering moving that money into a life insurance policy, could be whole life, could be IUL, where your dollars are now going to do multiple jobs. And with a proper design, has very low expense, very high liquidity. That is where I advocate for storing those emergency funds. And things just get so much easier throughout the years, especially if you don't encounter emergencies, and that money can just do more for you, paying for a death benefit and giving you good, consistent growth that should be outpacing inflation. And there's a lot of reasons to rest easy when you find yourself in that position instead.
Absolutely.
Next week, we're going to do episode 5, how to start building your own banking system. It's the implementation phase. Be sure to join us for that. I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. We'll see you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.